Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing the latest developments regarding the Bank of Canada's rate cut odds for March, which have dropped to 30% following the release of recent inflation data. This update is based on a report by Steve Hubel at Canadian Mortgage Trends. Canada's headline inflation rate increased by 1.9% year-over-year in January, slightly rising from December's 1.8% and aligning with expectations. This increase was largely driven by higher energy prices, notably gasoline, which saw an 8.6% rise, and natural gas, which increased by 4.8%. Interestingly, the goods and services tax holiday that ran from mid-December to mid-February offered some relief by reducing prices for specific items. For instance, prices for food purchased at restaurants fell by 5.1% year-over-year, alcoholic beverages decreased by 3.6%, and prices for toys, games, and hobby supplies dropped by 6.8%. Core inflation measures, which are closely watched by the Bank of Canada, presented a mixed picture. The Consumer Price Index, excluding food and energy, remained stable at 2.2% year-over-year. However, the seasonally adjusted annualized rate for this index slowed significantly to 1.6% in January from December's 4%. On the other hand, the Bank of Canada's preferred core inflation measures, CPI trim and CPI median, both edged higher to 2.7% year-over-year. This indicates that underlying inflation pressures persist. Moreover, the 3-month annualized trend of core inflation has been tracking above 3%, suggesting that core inflation could continue to rise in the coming months. TD economist James Orlando noted that this trend should continue to grind higher. Following the release of this inflation data, market odds of a 25 basis point rate cut at the Bank of Canada's March 12th policy meeting fell to under 30%. Derek Holt from Scotiabank remarked that there is too much underlying inflationary pressure in Canada to justify further easing of monetary policy by an inflation-targeting central bank. He also pointed out that the current state of the job market, which showed higher than expected job growth in January, does not support further easing. Holt emphasized that Canadian inflation remains too warm for the Bank of Canada to continue easing. However, economists are divided on the Bank of Canada's next steps. Some, like Oxford Economics, anticipate that the bank will continue cutting rates in the coming months. Tony Stillo, Director of Canada Economics at Oxford, stated that the bank will face a dilemma as it weighs higher prices due to tariffs against the drag on economic growth. He believes the Bank of Canada will look past the temporary price shock and instead focus on the negative implications for the Canadian economy and increased trade policy uncertainty. Stillo predicts the policy rate could be lowered by another 75 basis points to 2.25% by June 2025. TD's James Orlando also highlighted the challenge facing the Bank of Canada in balancing these competing priorities. He questioned whether the bank should weigh the downside risks to the economy in light of U.S. tariffs or focus on recent economic strength and its impact on inflation. Orlando noted that a lot could change between now and the next Bank of Canada policy meeting, given the dynamic global economic environment. Let's turn our attention to the latest trends in the Canadian housing market, where new construction has been on a decline, according to a recent report by Christian Gravenor from CoStar News. The Canada Mortgage and Housing Corporation has projected that the country will experience a slowdown in housing starts until 2027, largely due to a decrease in new condominium projects. In Toronto, the rate of new housing construction has fallen significantly by 41%, with a notable decline in multi-unit builds. This reduction in new construction is not isolated to Toronto, as it reflects a broader trend across Canada. However, there is a silver lining in Vancouver, where the city is expected to gain about 1,000 new housing units through a three-building project by Beatty. Vancouver remains one of the few bright spots in Canada's housing starts. The decline in new construction can be attributed to several factors, including rising construction costs, regulatory hurdles, and shifts in demand. Developers are finding it increasingly challenging to initiate new projects, particularly in the condominium sector, which has been hit hardest by these obstacles. The decrease in housing starts could have long-term implications for the availability and affordability of homes in Canada, particularly in urban areas like Toronto, where demand continues to outpace supply. While the slowdown in new construction may pose challenges, it also presents opportunities for policymakers and industry stakeholders to address the barriers hindering development. By focusing on streamlining regulations and incentivizing affordable housing projects, Canada could potentially mitigate the impact of these declining housing starts. It's also worth noting that despite the overall decline in new construction, some regions continue to see growth. As mentioned earlier, Vancouver is expected to add new units, which may help ease some of the pressure in that market. This growth is a testament to the city's continued appeal and the resilience of its housing market amidst broader national trends. Sean Cathcart, senior economist at the Canadian Real Estate Association, highlighted that January saw a notable increase in new residential listings, marking an uncommon trend for this time of year. The seasonally adjusted rise of 11% from December was one of the largest on record, outside of the pandemic period. Compared to January last year, new listings jumped by 23%, with the Greater Toronto Area experiencing an almost 50% increase. This surge in listings, Cathcart noted, coincided with a weakening in sales towards the end of the month, largely due to uncertainty surrounding tariffs. The Canadian Real Estate Association reported that home sales in January were down 3.3% from December when seasonally adjusted. However, on a year-over-year basis, sales were up 2.9%. This dichotomy reflects a broader trend where, despite the increase in listings, sales were impacted by the economic uncertainty tied to the inauguration of U.S. President Donald Trump and the potential for new trade tariffs. Sean Ziegelstein, a broker with Royal LePage Community Realty, pointed out that the uncertainty in the market, exacerbated by the upcoming Ontario and federal elections, led many sellers to list their properties at the start of the month. Despite this influx of listings, the average home price was relatively stable, showing a modest 1.1% increase from a year ago, though it did see a 2% decline from December on a seasonally adjusted basis. The aggregate benchmark price in January was $720,500, which was up just 0.2% compared to the previous year and down 0.1% from December. Ziegelstein noted that while the rise in listings hasn't yet significantly impacted prices, it provides buyers with more opportunities to negotiate. He emphasized that traditional economic theory would suggest that increased supply should lead to lower prices, but that trend has yet to fully materialize. Rental rates have also been affected, with a decline to an 18-month low in January, following a 4.4% year-over-year decrease. This drop in rental rates is occurring alongside a wave of condominium completions expected this year, which could further influence the market dynamics. Despite the increase in listings, the total active listings at the end of January, nearly 136,000, were still below the long-term average of around 160,000 for this season. This indicates that while there is an increase, the market remains relatively constrained compared to historical norms, as noted by the Canadian Real Estate Association. In Ontario, real estate prices have shown a year of stability, according to the latest figures from the Canadian Real Estate Association. As of January, the average single-family home in the province sold for $960,300, marking a 1.3% increase from the previous January, when homes averaged $947,700. It's important to note that these numbers are seasonally adjusted and do not take inflation into account, which currently runs between 1.9 and 2.7%, depending on the measure used. Sean Cathcart, a senior economist at the Canadian Real Estate Association, highlighted that concerns about potential U.S. tariffs have contributed to a dampening effect on sales. He noted that January saw a significant increase in new supply, an uncommon trend for this time of year, while sales weakened toward the end of the month, coinciding with heightened tariff uncertainties. This timing suggests that the uncertainty around tariffs is a key factor influencing demand. In a broader context, U.S. President Donald Trump's threats of tariffs, which have escalated to threats of annexation, began around his inauguration in early January. This has added a layer of economic uncertainty that could affect the Canadian housing market. The increased supply, alongside this uncertainty, has led to a softer pricing environment, particularly in regions like British Columbia and Ontario, where markets had been tightening steadily since last fall. Looking at different property types, prices for condos in Ontario fell by 2.5% year over year, while townhouses maintained a steady increase of 0.9%. James Mabey, the chair of the Canadian Real Estate Association, expressed concern over the looming threat of a trade war with the United States, noting that this could keep some prospective buyers on the sidelines. However, he also pointed out that a softer pricing environment, combined with lower interest rates, could present opportunities for others. Within Ontario, certain areas have fared better than others. Sales in northern regions of the province have shown stronger growth compared to other areas. For instance, single-family homes in Sault Ste. Marie saw a 12.1% increase year over year, while those in North Bay rose by 10.1%. Locally in the Guelph area, single-family house prices increased by 7.1%, condos decreased by 3.5%, and townhouses rose by 1.9% compared to January 2024, all using seasonally adjusted numbers that are unadjusted for inflation. The Canada Mortgage and Housing Corporation, commonly referred to as CMHC, is set to release its regional housing market outlooks on Thursday, February 20th, 2025. This announcement will provide key insights into the housing market trends across various regions in Canada. The release of these outlooks is highly anticipated by industry stakeholders, policymakers, and prospective homebuyers alike, as it offers a comprehensive analysis of the current market conditions and future projections. The CMHC's housing market outlooks are particularly valuable as they shed light on both national and regional housing dynamics, which can vary significantly across the country. By examining factors such as housing starts, sales, and price trends, the outlooks aim to equip stakeholders with the knowledge needed to navigate the complexities of the Canadian real estate market. These reports are crucial for understanding the broader economic implications of the housing market, as they highlight potential challenges and opportunities in different regions. For instance, areas experiencing a boom in housing starts might face different economic pressures compared to regions where housing activity is declining. The upcoming release will be available to the public through the CMHC's official website. This transparency allows all interested parties, from real estate professionals to everyday Canadians, to access the same data and insights, fostering a more informed marketplace. By providing these detailed regional outlooks, the CMHC continues to play a pivotal role in Canada's housing sector. The data not only aids in decision-making for buyers and investors, but also assists policymakers in crafting regulations that support sustainable housing development. As we eagerly await the release of these regional housing market outlooks, it's important to remember that while the data provides a valuable snapshot of current trends, the housing market is inherently dynamic. Economic factors, government policies, and global events can all influence market conditions, making it essential for stakeholders to stay informed and adaptable. In a recent development from the Financial Services Regulatory Authority of Ontario, also known as FSRA, the agency has taken decisive action against Shah Atta Hussein Faridi. FSRA has revoked Faridi's Mortgage Agent Level 1 license and refused to issue him a Mortgage Agent Level 2 license. This action comes after it was determined that Faridi made false statements or provided false information in his application for a mortgage agent license. The decision to revoke and refuse Faridi's license was made based on findings that his past conduct does not afford reasonable grounds to believe he will conduct mortgage dealings with integrity and honesty. This conclusion was reached as part of FSRA's efforts to ensure compliance with the law under the Mortgage Brokerages, Lenders, and Administrators Act of 2006. Specifically, these actions are grounded in subsections 1, 2, and 3 of Section 10 of Ontario Regulation 409/07. The revocation and refusal to grant a license were directed by the Financial Services Tribunal, following a decision dated December 9, 2024. The tribunal's decision instructed the Chief Executive Officer of FSRA to execute the Notice of Proposal, thereby ensuring that Faridi is not permitted to operate as a licensed mortgage agent in Ontario. This case highlights FSRA's commitment to upholding the standards of the financial services industry in Ontario. By actively monitoring and enforcing regulations, FSRA aims to protect consumers and maintain the integrity of the mortgage industry. For those interested in learning more about FSRA's enforcement activities, the agency provides access to its enforcement database, showcasing its ongoing efforts to safeguard consumer interests. As always, it's crucial for professionals in the mortgage industry to adhere to the highest standards of honesty and integrity. This ensures not only compliance with regulatory requirements, but also fosters trust and confidence among consumers who rely on these services for their homeownership journeys. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder: Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.